Upstart stock is soaring by more than 43% on the day after the company reported quarterly financial results. After the markets closed on Thursday, November 7, Upstart told investors that revenue is increasing, profits are improving, and lenders are more interested in making loans on the platform, all of which is great news for Upstart stock investors. So in this video, I'm going to review those latest financial results and highlight all the aspects that investors really liked about the company's latest results and update my recommendation of Upstart stock. I have not had this stock rated as a buy this year. I rated it a hold or market perform, and you're going to want to tune in to see if these following results were so good that I'm raising the recommendation here. So let's take a look. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Upstart reported total revenue of $162 million, which was an increase of 20% from the same quarter last year. Now, this was a big improvement. The company has experienced several consecutive quarters of flat to declining revenue following the central bank's increases in interest rates in 2022. That created huge headwinds for Upstart as lenders on the platform got increasingly concerned about a recession. And of course, if you're a lender and you're worried about a recession in the near term, you don't want to make loans because the people that are borrowing money, they could lose their jobs. And if they lose their jobs, they're probably not going to pay back their loans. And so lenders, growing cautious, pulled away from the platform, and that created a mismatch. There were still borrowers willing to borrow. There's never a shortage of borrowers, as I like to say. There's always people that want to borrow money. But the difficulty for Upstart was finding the lenders to make those loans. So in the last few weeks, lenders have become increasingly optimistic about the economy, and that's been noted by an increase in lending activity. A couple of weeks ago, if you didn't see those, I made a couple of videos for Upstart and SoFi where they signed deals with third-party lenders who wanted to purchase up to $2 billion worth of these types of loans that Upstart and SoFi make. So that was yet further evidence that lenders are coming back into this category, and Upstart is poised to benefit as a result, and they're already benefiting as a result. In the latest quarter, they made 188,000 loans, and the conversion rate on request was 16.3%, up from just 9.5% in the same quarter last year. And the conversion rate, you could think of this as matchmaking on the platform. The borrowers coming in were requesting loans, and they were able to get matched up with lenders 16.3% of the time compared to 9.5% of the time last year. And if you keep in mind that there's always an influx of borrowers, this signals that lenders are now more interested in accepting those applications from borrowers to borrow money. And so it's an increase in optimism about the economy, and Upstart is a bellwether for those investors that are weighing the macroeconomic outlook when making lending decisions. Upstart uses artificial intelligence to make decisions, recommendations on their borrowers, and they aim to offer a better model than the traditional methods of using a person's credit score to determine if they should borrow, if they should be allowed to borrow money, and if so, at what interest rates. This model has yet to be proven, as I've been saying, because they haven't been through a recession. Once the company goes through a recession and you can compare how their lending portfolio matches up with traditionally funded loans, you can know as a lender what the performance is going to be. As of right now, lenders are not certain yet what the performance will be, but because the economy is doing much better than expected, lenders are willing to take a chance here given the increased interest rates that they can get from borrowers on the Upstart platform. So it's an interesting business model. It has really high potential, And of course, if you've been watching my videos, you know that I like the platform business model, where the business itself, all they do is bring together two sides of an equation and take a fee for offering their services. That's what Upstart aims to do. And the market they're in, lending, is a massive market opportunity. And so I like the prospects longer term. I like the business model. My only concern with Upstart has been the unproven nature of the AI model, even though it could be, I could see it being better than traditional methods, because traditional methods have not been great. And so I do see opportunity for disruption. And then my other caveat has been with valuation, and I'll talk a little more about valuation later. Net income in the quarter improved to a loss of 6.8 million. That was up from a loss of 40 million in the same quarter last year. On this front, Upstart has already proven itself. If you remember a couple of years ago, when people were borrowing and the economy was performing really strongly following government stimulus, Upstart was generating strong profitability on the bottom line. So they've already proven that this business model can generate strong profitability at larger scale. So that part of the business, they've already proven. The part that I was talking about earlier is just relating to their lending model and how that will compare to traditional lending models. And we won't know that until there's a recession. So that part remains uncertain. But in terms of the business, will it be profitable at larger scale? They've already proven that. So that's one area of risk that's decreased for Upstart stock investors. The company is forecasting the good times to continue, saying revenue is expected to be 180 million in the next quarter. That would be up by roughly 20 million from the current quarter, where they generated 162 million. But surprisingly, they're forecasting losses to increase on the bottom line. A net loss of approximately 35 million is what they're forecasting in the next quarter, when they just reported a net loss of 6.8 million in the current quarter. So they're going to get 20 million more in revenue, but they're expecting a bigger loss. That was a little curious. Still, I think investors were focused on the fact that revenue is increasing and accelerating as the company is forecasting higher revenue in the next quarter. So Upstart gives investors this interesting slide here where they give you the UMI, which is the Upstart Macroeconomy Index. And they explain that for a given UMI, let's say if the UMI is 1.25, that suggests that the macroeconomy caused default rates to be 25% higher than usual. So the September UMI was 1.52, which signals that defaults were 52% higher than usual, than the long run average. But what you notice is that it's improving. The economy is getting better from the situation where it was in a couple of months ago, where investors were a lot more cautious and the macroeconomic data was not as good as it is now. But I would argue that the macroeconomic data hasn't changed all that much in the last 6 months, other than employment growth slowing down, inflation improving, and the central bank decreasing interest rates. So that's what I believe is causing the macroeconomic outlook to improve, is that the central bank is lowering interest rates in response to lowering inflation. And if interest rates are decreasing, that's great news for a company like Upstart, which has increasing exposure to macroeconomic trends. And so a recession will hurt this company more so than it would hurt the average company in the US. So it was a strong quarter, and I understand why the stock price is up by so much. It's up 43% following this news. And now the stock is trading at a forward price to sales of 9.5. This is the most expensive the stock has been all year long, and it's roughly triple the valuation it was trading at around April to July. So the valuation has tripled in about 6 months. And while I highlighted all the things I like about this company, the longer term prospects, the really high potential for reward, I think at this valuation, there's still too many question marks for me to upgrade this stock right now just yet. But I wouldn't be surprised if this is a company I upgrade in the near future because of those fundamental aspects about the business that I really like. The platform business model, the massive total addressable market opportunity, and in an industry that's ripe for disruption. I'm just not ready to make that jump just yet at these current valuations. So I'm reiterating keeping this stock rated as a hold.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.